We'll start in another 30 seconds.
Can see us now? Hello. Yeah.
Yeah.
Should let people know this is the highest attended event ever.
So I'll begin as people keep on joining. But hi, everyone. Welcome to the fourth panel of Digitizing Make in India. I'm Sudipto, and I lead B2B marketplaces and climate tech investments at Matrix Partners India. As we have mentioned before in prior panels, at Matrix, we are big believers of B2B. Over the past few years, we have seen significant tailwinds in the overall B2B and agri space, which is why we have invested in over 10 companies and also more recently partnered with McKinsey to launch Digitizing Make in India, or DMII, which is a report on the state of B2B markets in India. As part of DMII, we have already surveyed 100 plus stakeholders across startups, incumbents, policymakers, and investors. We've also conducted panels on manufacturing, agriculture, exports, and now we are on to our final panel, which is on global investor perspective on these sectors in India. Over the last couple of years, and especially in 2021, the B2B sector in India saw significant global funding, with more than 30 companies in India today valued at over $100 million. However, as markets have turned, there have been multiple questions around B2B companies in India as well. What is the role of tech in B2B? Do these businesses make sense in a high interest rate environment? How should we value B2B companies, and what does it take for B2B companies to IPO? To answer them, I could not have asked for a better panel of experts who have each defined the Indian startup landscape with investments in category-leading companies across sectors, including in B2B. I'll hand over to Avi, founder and managing partner at Matrix, to introduce the panelists, and we'll take it from there.
Sounds good. Thank you, Sudipto. I don't know how to say this, but I have no choice because I'm born and raised here and I have to invest in India. But the panelists here all have a choice and they choose to be India bulls. So I'm super excited to have this quality of a panel, starting with Scott, who's a co-founder of Tiger. I've known Scott now for many years. And what I love about every interaction, by the way, I have some notes that I'm supposed to read from, but I'm not. So what I love about every interaction with Scott is the clear thinking about India. And so Tiger Global is very well known. He's one of the smartest, clearest thinkers I know about the India opportunity. So welcome. Navroz and I also go way back. One of the sharpest brains in the business. Actually, just earlier this week, we were talking about some other company. Also, very clear thinker, long-term India bull, started before anybody else. So thank you, Nav. And he's also a buddy. And Vishesh is like the ultimate, should I say, the ultimate unlimited capital for India. No, I'm joking. So thank you. Also, Temasek is like one of the most and what you find in when the markets turn is who's the real believer. And Temasek, I believe, is a real believer. They are doubling down and actually increasing the investments in India as the environment has turned. So, Vishesh, thank you also, and lovely to be here.
Thanks, Avnish. A pleasure.
So thanks, Avi, for the introduction, and great to have you all. Thank you so much. We'll start with a broad overview question. I think in this panel, everyone here has invested in a lot of category-leading B2B companies. It's a two-part question. What is your high-level thesis for the B2B sector in India? And are you bullish on it long-term? And the second part to it is a lot of the B2B businesses made sense in a low interest rate environment. Has your thesis changed in the current environment? So would love to hear your overall.
Sorry, Dada, I'm gonna zoom out a bit also to say, given the caliber of the panel, to also say what is the thesis on India in general, and then we'll come to B2B. And given what's been happening, given China and all that, and I know, Scott, you and I exchanged messages on this multiple times. How do you see it? So let's start macro and then we'll come to B2B.
Yeah, so I guess the first thing that we think about is like, where do we want our own capital? And we have long believed that India is going to gain share of global GDP. As you all know, it's 20% of babies born today in the world-ish, plus minus 20% of babies born are in India, and it's only 3% of global GDP. So quick chart. Over the last, I guess, close to 20 years, India has gone from something like 5% the size of the US, so 1/20th of the US economy, to now about 1/7. And this is just, you all know the way compound interest works. If one thing compounds at 2 or 3 and one thing compounds at 6 or 7 for 20 years, the ratios change a lot. And India, I mean, China's been fabulous too. When we started 20 years ago in China, China had around 18% of the world's population and 3% of global GDP. 3% has grown to 14%. So China's economy is now something like 75 or 80% the size of the US economy. And when we started, it was 14% the size. So, and conveniently, if you're paying the same multiples or similar multiples for companies in different geographies, well, if you can pick a place with a lot more growth and quality growth, well, and you can do it at the same multiple, that's great. And so that's our perspective today on India. And that was our perspective on China 20 years ago. So we think India is likely to have the highest equity returns in the world, having nothing to do with B2B, just investing in equities. We suspect that it will be the best place to invest. Yeah. And then in terms of...
So just to follow up on that, it's all... A lot of the times people say, but India is too expensive and it's always overvalued. So what's your view on that?
Stop making excuses. Stop making excuses. That's not what we've observed. And we think that we're just getting to, let me just give a few examples. And I'm sure many other panelists can do it. We were able to purchase 16 or 17% of Flipkart for $8 million in 2010. In B2B, we were able to purchase 10% of Inframarket for $8 million in early 2019. We were able to purchase almost a third of Upstocks, which is one of the 3 market leaders, for $50 million in 2019. So there are plenty of opportunities. I think that there are, and this is a good thing about India. If you look at public markets today and you look at the small number of internet-enabled companies, whether it's Zomato, Delivery, Policy Bazaar, there's not that many, a Paytm, they do trade at better multiples than their US and China counterparts because they're growing faster. They're growing faster on average. And so I think everyone who invests, all of the panelists, including, you all at Matrix, we all believe that there's plenty of ways to invest at a good price in a great company in India.
So if I may add to that, Scott, I think that's absolutely correct. And Avnish, we've done some analysis to see, at comparable levels of penetration, how today, companies that trade, that are, huge outcomes that are best in class globally, where they traded in terms of multiples, at similar levels of penetration. And you find that, India is not too out of whack, right? You've got to take a long-term view, and you've got to, to keep believing that GDP will keep compounding as it has. And then, in that context, it doesn't look outrageously expensive. Also, just answering your question, your earlier question on how we think about India. So Temasek has been present in India now for 2 decades. We started our first international office outside of Singapore in Mumbai, right? And that was a couple of months before we started our China office, something that I'm incredibly proud about. But we are global investors. We invest money all over the globe. But incrementally, I think we're seeing the same thing that Scott is saying, that a large part of global growth is going to be driven from India, and and there are multiple reasons, right? Demographics, political stability, just increasing purchasing power, increasing efficiency in infrastructure, and so on. And so, we are allocating much more of our capital to India than before, right? We remain extremely bullish in the long term on the country.
Great, fantastic. Thanks, Vishesh and Scott. But now narrowing it down to B2B, right? Scott, probably you picked up B2B 5-6 years back, right? When you started investing in B2B. Would love to hear what was your thesis and why did you choose B2B investing in India?
Yeah, we started really, we just had some existing investments that were performing awesome. Specifically for us, I think the first B2B investment we made in India was, I think it was delivery. I could be wrong, but I think it was delivery. And we were really impressed with the founder. And also just as it got bigger, it's a classic route density business. It's not that dissimilar from a Flipkart or Amazon or JD, where as you get bigger, gross margins tend to go up, but not because you're raising prices to customers, just because you're able to get efficiency. And if you can get 100 packages through a warehouse in a day versus 60, your costs don't grow linearly. And the same thing with variable delivery costs. So we just see typically gross margins go up over time, and you see operating costs as a percentage of revenue go down, just classic route density businesses. And and B2B has been a durable category. I was watching a basketball game last night, and I think a Grainger commercial came on. So, these have been businesses both in the U.S. and China where if you can build scale and add value to customers, you can build a really good business and generate good returns on equity for your shareholders and for your customers. And so we really started in earnest, as you said, 5-6 years ago. And just tried to be pretty strategic, whether it was industrial, retail, freight and logistics, e-commerce enablement, agriculture, and just go through the biggest categories of cars and go through the biggest categories of the economy and see if we can meet great people that could help make procurement or whatever it was more efficient for customers.
Got it. Fantastic. Nav, would love to hear your views as well on this.
On the B2B space in particular?
Maybe a little bit on India, and then we can narrow it down to B2B.
Look, I think I would really sort of echo what Scott said. When you dial back and sort of step away from, companies and sectors and numbers, and you just think about the big picture opportunity. I think Scott said one in 5 babies is born in India, but 1 in 3 human beings under the age of 30 lives in India. The average age of the population is quite staggering, right? 1.4 billion people, average age 29, 30. I mean, you visit Japan or you visit Korea or even the US or Europe in particular, you drive from meeting to meeting. I often look out and I see so many old people, and then you're driving down the streets anywhere, it doesn't matter where you are in India, and you can see how young the population is, right? And it's an aspirational Western looking population. Politics has sort of fallen into place. Our sort of closest peer group is in disarray. Russia is uninvestable. China is not uninvestable, but difficult and tricky to navigate. Certainly way more so than India now because of governance at the center. Brazil is starting to go back into a period of governance under sort of a left of left socialist. So the BRICS are sort of in disarray. Our noisy neighbor to the left is sort of preoccupied with its own stuff. So I think for us, for India, as long as we have a benign global environment and the US is okay, and there's growth in the US, and there's not a global sort of risk of trade, and nothing bad happens with China, I think this is about as good a setup for India from a big picture as I've ever seen in the last 15 years or 20 years. The confluence of factors is enormous, including sort of the resettling of massive supply chains, not all of which will end up in India, but even if a few on the margin end up in India, it takes the pressure off the government in terms of job creation, et cetera, and the build out of attendant infrastructure. So I think the setup is really good. But look, this is a multivariable world, right? Things can change very rapidly. Oil prices are important. Politics is important. Yeah, but it's a good setup.
So on that note, what's the contra thesis? I know, Nav, you love to think like that. What's the contra thesis on India? We have
the contra thesis, I think, is fairly. There is a contra thesis out there, and the contra thesis, there are parts of it which I am very mindful of, and I push our team constantly to not just to embrace, but to actively seek out sort of the non-confirming data points. It's actually something that we've learned from our interactions with Tiger over the years. But it's expensive, which I pay less credence to, because if you look at Indian companies, even on the public markets, that have generated a 17+% ROIC through cycles, there are basically 20 of them, no more, right? Despite the thousands that are listed. Those companies have traded through cycles, no matter what, at 30, 40 times EV/EBITDA. Because if you're generating that ROIC, sort of by definition in India, India gives you the luxury generally of a long runway to grow, to Scott's point. So you're generating above your cost of capital for much longer than companies in other markets could or other countries could. So things trade well in India at rich, at robust multiples over cycles, even some of the worst cycles, 2007, 8, 9, then 2012, 13 again. 99, 2000, 2001, we look back 30, 40 years where these companies traded. But on the flip side, there's a reason there are only 20 or 25 or 30 companies that generate a 17% ROIC. And that's the contra argument. The contra argument is that it is an incredibly difficult country to monetize because of the purchasing power currently of people, that although I might sit here and give a speech about 1.4 billion people, average age of 29, there are really only 100 million of them who are true consumers for the sake of the people on this panel. And of those 100, really 60 million are durable sort of high ticket consumers. And so that market needs to grow quicker. And so you should really think of India as more like a $200 million person market than a 1.4 billion person market. Then the other 2 points are just corporate governance. It's always been an issue in India. There are a cadre of founders and people who believe in shortcuts, who, personal integrity matters less to them. They're brought up differently from you and me and Scott and Vishesh and Sudipto. So you've got to adjust for that. In the past, there was also a political governance issue, but that, I think, we're about as stable and as Goldilocks a scenario now as we can be. So for me, the contra argument, of these contra arguments, and then you've got to always watch dollar strength, oil price strength, sort of noisy neighborhood with China and Pakistan. For me now, the big enduring one is just, the wallet size and the breadth and the depth of the Indian wallet.
Well put. Scott and Vishesh, you guys have money that can go anywhere. So how do you see macro, coming back to macro for India?
So I think the biggest risk in India, I think it's the biggest upside. As you all know, returns on equity, if you were to look at internet companies, where we've largely focused our capital over the last, I guess this is year 17 or 18. I think our first investment was either Just Dial or Make My Trip in early 06. So assist to Feroz Dewan. Thank you, Feroz, for leading our first couple investments. He's awesome and helped get us rolling. Returns on capital in India have sucked historically. And if as I think many of you know, if you look at market leading internet companies, whether it was Google or Facebook or in China, Alibaba and Tencent, revenue got bigger than costs more than a decade ago. These things went profitable in the US. The big internet companies went profitable in Yahoo, I think, became profitable, whether it was 05 or 06. Heck, Netflix for a period generated cash, I think, in 05 or 06 and so you had a great legacy of, for the last 17, 18 years of materially profitable internet companies. And so returns on equity in the internet got really high, and returns for investors have been really high. Okay, well, I think most of us on this Zoom can attest to the fact that did not happen in India until very recently. Really, until the last 2 or 3 years, you had rounds to no profitable internet companies. And to Nav's point, you did have other areas, whether it was banking. I believe that India is the second highest banking ROIC in the world after Brazil.
Yep.
The average bank in India has a 17-ish% ROIC versus 20 in Brazil. So it's not like there are no industries in India that have high returns on capital. It was just internet companies. Typically, it was our expenses are going to be bigger than revenues, and it's going to last a while. As a result, returns on capital for investors like us have been below average in India, way below. Like our returns in India, our IRR in India, I think is something like a 20% gross since inception. That compares to something like mid-30s in the US on the private side and low 50s in China. But that's the past. Well, what I think we've all started observing over the last 3 years.
This is a great point. So we have about 200 people watching us right now, including most of them are founders. So what are we doing wrong, both as investors and founders?
I don't think you're doing anything wrong. I think that we didn't see it as structural. We viewed it as there wasn't critical mass. They're just, the GDP of the whole country today is only whatever, 3.5 trillion. And 3 years ago, when it was a little bit under 3 trillion, and it was 2 and change trillion, and all of a sudden, the internet-enabled economy hit around 100 billion of sales. If you add up Flipkart and you add up Amazon India and you add up, and the two companies that are actually making a lot of money in the internet, they happen to be foreign companies. It's Google and Facebook, and they built extremely awesome businesses in India. Thank you to them. I think it's I think it helps the whole ecosystem. But those net profits are going to shareholders, in holding companies based in the US. You finally hit 100 billion of sales 3-4 years ago. And since then, we have seen incremental profit margins on market leaders be fabulous. And so this big risk that you would have a great country that would gain share of GDP, the demographics are amazing, but there just wouldn't be excess profit pools, that could have a sustainable competitive advantage. We think the odds of that have fallen off a cliff.
I thought you were going to pull up that spreadsheet you showed me, which is until 2016 and post 2016.
Well, okay, so here is a great snapshot.
He does.
Okay, well, if you're gonna prompt me, I'll do it. So interestingly, focus on the right side, this inflecting unit economics. If you look at one of our larger private holdings, you have seen expenses a lot higher than revenues, but the trajectory over the last few years has really changed. And actually, we've looked into why it didn't improve in 2021. There were a few big companies that kind of skewed the numbers a bit. So I think this is even not representative. It did start happening closer to the second half of 2020. You've seen industry consolidate. Yet the penetration, if you look at the left side, yet the penetration of things like e-commerce today is so much lower. And so, we should enjoy higher growth rates, and we are. Not should. Today, who knows about the future, but today, market leaders in India are growing faster than their comps in the US and China. And it is in large part because penetration rates are lower. Unit economics are improving. We all have lots of investments now that make money.
Super.
We're not, and fewer that are unsustainable also. And so I think that as a result of low returns historically, I think India entered this downturn better positioned, certainly versus the US. Because you haven't had as much excess. I don't think there was as much excess capital in India as there were in a few other places.
So if I can just add to that, right, I think I agree with whatever, Nav and Scott have said before, right? I just want to add one more perspective to it. It is absolutely true that purchasing power in India is way below, any of the comparable economies that you could invest in. But I think, the real differentiation that Indian companies have over their counterparts in other parts of the world is actually cost. Right. And this is something that, that it's a nuance that, dawned on us, quite late. But if you compare side by side, right, and by the way, we are investors in both DoorDash and Zomato, right? If you look at, just on a per order basis, right, how much revenue each makes, right? DoorDash makes, circa $35, $40 per order. This is the take. And Zomato makes, $3 to $4 an order, right? But if you look at the cost, on a per order, Zomato is actually way lower than DoorDash, right? It's much better than 1/10, right? Similar example, what Zomato makes in a metro city in terms of, per order is obviously higher than what it makes in a tier 2 or tier 3 or tier 4 city, right? But the costs for serving that order in the tier 2, 3, 4 cities are way lower than, even comparatively than the metro, right? So it's actually much more profitable, right? So I think, there's a combination of, look, today, all our household spend was just spent on, basic groceries and education, right? So we didn't have anything to spend. But over time, as that improves, as we hit more than $2,000 per capita, of GDP, I think that's going to change. And, incrementally, because our cost structures are so low, our return on capital should be, much, much better than it has been in the past.
But that's a great point. I actually didn't think of it like that. You're saying globally, our AOV is lower, but because our cost structure can be much lower, and if you can get the efficiencies going, your ROI can still be like whatever globally.
So, and you don't even need to look, you don't even need to believe, right? Look at TCS, right, or Infosys versus Accenture, right? What they make on a per FTE or whatever per unit. Compared to Accenture or Globant or one of these guys is actually lower, right? The revenue is lower, but costs are way lower, right? So your ROE for TCS or Infosys is infinite.
I think I would like push back on that, because the IT sector didn't. It was a simple labor arbitrage, and it didn't require any infrastructure. I don't know any company in India that can deliver anywhere in India for less than $1. So I do agree with you, Vishesh, that there is some delta in tier 1 and tier 2, tier 3 deliveries, but it's not as variable as you would imply. The other thing I would point out, again, in the spirit of being the sort of the contrarian here, is that Scott made a really interesting point. Facebook and Google are the Facebook and Google of India. And so if you're building a tech business in India that doesn't have a differentiated way to access customers, and by the way, everyone is chasing the same 100, 120 million customers, you're paying sort of not US CPMs, but sort of somewhere in between emerging market and US CPMs to Facebook and Google with Indian AOVs. And attendant sort of Indian infrastructure bottlenecks on delivery and sort of customer NPS. And so one of the big things that I try and always find a way around, and I fail more than I succeed, which is par for my course, is finding Indian internet companies. Scott's done a great job in finding the upstarts and sort of those early companies that were first movers, built a brand, low CAC, right? But I think it's a really interesting conundrum that I battle with, which is how many of these tech companies in India have a differentiated way to identify, find, and onboard a customer that is outside of Facebook, Google, Instagram, YouTube, Snapchat, because those CPMs are sort of set potentially in America. Our wallet sizes are Indian, and there's a delta between that. And that's one of the reasons why B2C has been so much harder to build and monetize in India.
Oh, it's a great point, Nav. Sorry, Sudipto, we are going off script, but I think it's useful for people to listen to this. 100% agree. I think the issue with India is unlike with the outsourcing business, where it was rupee costs and dollar revenues, we have the opposite. We have dollar costs and rupee revenues, right, with the D2C business, because you're paying the global CPMs. So, and I heard you say part of the answer, but I would love everybody to add to it. So therefore, from what I heard from you, focus on building a business that is low CAC, like, you know, some level of virality, whatever it is, but basically a low CAC business.
Or a B2B2C business, which I think the other thing with China, which and I actually think this was a conversation that I came to this realization as a result of a conversation with Scott many years ago. China has these super apps, right? They have these super highways, 4 or 5 of them, or you can say 6 of them or 3 of them. That sort of all traffic is funneled down, and you can. A lot of the businesses that have succeeded in China, VIP shop, et cetera, they're sort of ancillary roadways and bridges that connect and crisscross these super highways. We don't have that in India, right? So if you can't, we're acquiring one customer at a time on Facebook, on Instagram, on Google, on affiliate marketing. Sort of, you're not in control of your destiny. You're not a price setter, you're a price taker. But I think the way around that is sort of find nodes that aggregate customers, and until we develop sort of more robust platforms, whether it's a daily hunt or an off business found an ingenious way of finding its customers through the bid assist, through technology. We have to think about B2B2C or some sort of aggregated form of customer acquisition.
Yeah, so I mean, look, I just want to, you know, your point absolutely is correct, Nav. So, you know, what I'm saying is that, you know, 10% in steady state, right? 10% of your cost is going to be set by, you know, customer acquisition, right? And the remaining, you know, call it 60% of costs are people and, you know, gross margin and so many other things, which are structurally better in India. And I think the thesis is that, right? So the thesis for us has been to find those businesses that can acquire customers cheap and can deliver services cheap, right? And that's how you make incremental returns. And there are, you know, it's a growing list of companies that are spending less and less on CAC, and I'm sure it'll just keep expanding.
So the one thing I would just underline, which I'm in complete agreement with Scott, is that across our portfolio, the number of companies that are struggling with unit economics versus 2 years ago, 3 years ago, 5 years ago is diminishing. And the number of companies where literally on a month-over-month basis, we're seeing improving economies of scale or network effects, and then improving unit economics is rapidly increasing. And we've got several companies that are generating EBITDA, even PAT, free cash flow even, and still growing 40, 50, 60, 80, even 100% year over year.
Scott, I remember you showed me numbers that were serious FOMO level, where you said China, you had a 80% IRR, and you have watched China over the last, decade plus. So what's working? What do you think? Are we the next China, or we are delusional? And what are the pattern matches that are working and what are not working?
I think India is going to be, with an extremely high probability, an enormous success, and it will be the biggest share gainer of GDP over the next 10 or 15 years. It is, as we all know, it's different than China. Over a 20-year period, at least we're not expecting that it goes from 3 to 14% of global GDP in a 20-year period. If it goes from 3 to 9, with a high probability, it will be the best place to be an investor. And if you can identify great companies early, it will produce the best returns over the next 10 or 15 years. And all it has to do is go from 3% to 8 or 9%, just because of just gravity. China is not going to go from 14, or it's extraordinarily unlikely that China would go from 14% of GDP to 40. So tripling GDP when you're at 14%, extraordinarily difficult. But when you have a third of the world's humans under 30, going from 3 to 8 or 9, highly probable. And what we love, and I think many of us have seen over longer periods, is these virtuous circles where when we first invested in this small online retailer in China called JD in late 2009, I never would have, they didn't own any real estate. So we never baked into any value for real estate. Now the company owns over 100 million square feet of land that is perfectly positioned, near dense population areas with high income people. And they went and strategically acquired it over the last 15 years or so. And that asset alone is worth billions of dollars, maybe tens of billions of dollars for JD. And when you look at what's happening, whether it's B2B or any real businesses, they are accumulating, even if they rent the locations, you're accumulating things that it's a network, right? Whatever your business is, if you can do it profitably. Now you got to get CAC right, and you got to manage it well, and you got to have great people and add value. But when we come back in 10 or 15 years, and that is why Blackstone and Brookfield, they are pouring billions of dollars a year into Indian real estate. Billions of dollars. And that's a good thing. And we think they're real smart. So what are the odds that we come back in 10 or 15 years and real estate prices aren't a lot higher? And if you were able to build a network now, and maybe you lease it, maybe you own it, but there's just, you're on mute.
Avi, you're on mute.
Sorry. So I was saying you're seeing the pattern play out. You made a ton of money in China, and are you seeing the pattern play out here?
Yes, it's slightly different, but India is gaining share of labor. Just period. The emphasis and IT outsourcing, and during this downturn, how many global companies are increasing the percentage of their labor that is in India? We're seeing it be very, very common. It's just a better deal. The level of talent and production that you get.
Sorry, I'm going to. So Dipto, let's use this. We are just a better deal. We should coin that term. It's awesome. Yeah.
We are seeing it. We are seeing huge layoffs right now, or layoffs. We are seeing net layoffs in the United States, where the supply and demand of great engineers, it's just there's too much demand for them relative to supply. And here's India graduating, I think it's a few million STEM graduates a year. And what you can get for a $50,000 a year employee, $100,000, $150,000, $25,000, what you can get is better on average. And that doesn't mean that Google and Facebook or Amazon, we're not expecting they're going to fire everyone in the US and hire everyone in India. That's not going to happen for a variety of reasons, but it is going to gain share of labor. It is going to likely gain share of capital. Let me give you an example of just too good of a deal. One of my partners got pink eye on the flight over to India in November or December. Checked into his hotel, told the concierge, within 2 hours, was able to go less than a mile, see a ophthalmologist, and get the drops that you need to cure pink eye or to help you with your pink eye. His bill was $16, 1/6. For $16, he was able to see a professional doctor who he felt totally comfortable with in a fine setting. He sent me a picture of the office, clean office for $16. That's just too cheap. And it's too good of a deal.
So for all the founders watching this, India, so please start now. No, but thank you. Thank you. Go ahead.
I want to bring everyone back to B2B because there are a lot of B2B founders out here as well. So first of all, great to hear this resonating thumbs up to India. And I think all the founders on the panel will be encouraged. But now within India, right, we spoke a lot of time on consumers, B2C businesses. I know most D2C brands are now moving offline because to what Nav mentioned, increasing cost of CAC, etc. So there are a lot of different areas within India that you can invest, right? And why B2B then? What is your thesis for B2B and agri-tech in India? Do you like B2B and agri-tech businesses in the long term? And within that entire spectrum, which kind of businesses do you really like? Because that will also help a lot of entrepreneurs in their thinking.
Vishesh, maybe we can start with you. You guys have invested a lot in B2B and agri and those spaces.
Sure. So I can take a stab at this, right? So look, I think the large market point has been made. The fact that you can build so many revenue streams has been made, right? I think the core of why we are optimistic or the bullish case on B2B is that almost any category you pick, right? The supplier base is quite fragmented, right? And highly unorganized, right? And so if you can just offer a product market fit to both your buyers and your sellers, right? And it's quite compelling, right? For a seller, you can offer increasing throughput, increasing capacity utilization. For a buyer, you can offer discovery, you can offer curation, you can offer quality control, you can offer compliance, right? It's not so difficult to do. And so we see a lot of businesses finding very good product market fit very quickly. And that's the bullish case. I think the idiosyncrasy in the market is that unlike B2C, where a lot of new habits are being formed, in B2B, I think there's a existing supply chain for almost any category you can think of, right? And so the way businesses are growing are through a share shift from unorganized to organized, or from manual or analog to digital, right? And in that context, because of the fragmentation of the market, there is very little or almost no pricing power, right? There is almost no propensity to pay for convenience. A consumer will pay for convenience, because of brand or because of whatever, but a business will never pay for convenience. At least that's our experience, right? So in this scenario, what your business model needs to be is to use technology and lower costs, right? If you can offer the same service at the lowest possible cost, that is the only moat, I think, in the business, right? If you're scaling up rapidly and then saying that I'm going to fix my unit economics once I get scale, that's not going to happen, because because of the fragmentation and the high competition in the market, your consumers will never pay you $1 more than what.
So Vishesh, let's push that over the next 2 years, given that you guys are one of the biggest believers and in all of you actually. How do you see your B2B versus, do you have a view on a B2B versus B2C investing over the next 2-3 years? How much money, how much capital would you allocate in each place?
So, we don't look at it like that. We are, very bottom up and granular in that sense. But I think, our first wave of investments was in brand businesses. So, a lot of B2C. I think we find that, SaaS, for example, right? And again, B2B is very, very wide, right? SaaS, IT services, logistics, payments, they're all B2B, right? But we think that, SaaS, because there is a real industrial logic, right? You have just lower cost, same or better quality, exactly the point that Scott was making. And you have global consumers, right? So I think, those are some areas that we want to double down on very quickly. But that doesn't mean that we'll allocate more money to B2B versus B2C. As you said before, right? We have an insatiable appetite. We'll do both.
What about you, Scott and Nav? Any views next 2-3 years?
When I hear the words B2B, I love it. And I also think about what I think about is the name of a company. Like, let's talk about Gupshup. Have any of you even heard of Gupshup? It is the closest thing that India has to Twilio. Classic B2B. As you all know, they largely buy capacity from the mobile carriers in bulk, and they offer messaging to companies to whether you're a Zomato driver or a Swiggy or Ola or Uber, companies communicating with their customers or their last mile delivery people. Fabulous business. And or inframarket, or of business. So B2B, it's about a specific company and serving a specific unmet need. And if you can do it at scale and add value to suppliers and customers, and your stakeholders, what else do you need? That's a business. And so
Scott, let me go deeper into that. So it's part of our thesis, and I want to get your view and Nav's view and Vishesh's view on whether we agree or disagree. It feels like in B2B, India has an edge. We have generally been behind in a lot of infrastructure build out, right? Hard infrastructure, we are way behind China. We used to want to, emulate, but it's not going to happen. But in soft infrastructure, it feels like we are ahead with the whole, biometrics, the Jandan, the, mobile stack, whatever. So it feels like we have an opportunity in digital, in B2B to leapfrog digitally what's not happened in other countries. So that's the positive thesis. The negative thesis or the contra view on that is that's all good, but these are all offline businesses and it's all spreadsheets and it's all Excels and it's, this is all basically we are as investors smoking our own dope. How do you think about that?
Yes, please. Yes.
Okay.
This is what's awesome about India is GDP per capita is $2,000. We haven't even gotten to the good stuff yet. This has all been like at a restaurant, you sit down, it's not even the appetizer, it's like the amuse-bouche. Well, all we've had is we've just had the little freebie. We haven't even gotten appetizers yet, in my opinion. And so businesses that can get, great person, big market, and start adding value to customers, at an early stage like today, I think it projects very well.
Nav and Vishesh, just FYI, the only non-Indian on this panel is the most bullish. So let's follow the cue. No, just kidding.
Yeah.
Go for it.
No, but again, I just reading some of the questions that folks are submitting. Yes, governance in India is an issue. Yes, unit economics are an issue. They are, and they need to improve. And and so I think what will determine whether or not the returns we get in India over the next 10 years are 17 or negative 17 or 37. It'll just be about the ratios of 100 companies that get started that we all choose to invest in, or you all choose to start and run. What percentage of them will act ethically to start? What percentage of them will build their business around a durable advantage that can be a win-win or a win-win-win between them, suppliers, and customers, but where they can make money, where it's not just in B2B, the classic example would be you generate net profit, but you have 365 days of working capital, and you're never going to make money if you look below the line. Maybe you'll generate EBITDA, but you're never going to generate cash flow. And we all, anyone who's on this Zoom, who's been in B2B for more than a nanosecond, we all know the tricks that you can play to build an income statement without building a business. And
all the problems with the balance sheet.
And the pattern we are seeing, and I think it will be helpful that we are in a period where cost of capital is high, but we were already seeing it when 2 years ago, just the ratios of companies that are run well and run for profit, it appears to be going up. And we're seeing the ecosystem, these second, third, fourth time founders, or maybe a first-time founder who worked at a great culture, whether it was Amazon or Flipkart or Google or Facebook, and they've come out of, or Zoho or Freshworks. They've come out of a venture-backed company or a global startup, global company in India, and they're bringing a professional environment.
Nav, Vishesh, anything to add?
Look, for us, I think the B2B space is attractive because within all the overall sort of country level metrics that Scott referred to, online penetration in B2B is less than 2% versus in B2C where it's 7, 8, 9, 10%. Massive TAMs, fragmented for the most part, highly inefficient. And all we singularly focus on is, can you disrupt that space through the use of technology and add tangible ROI to both sides of the platform? Clear value add. Because if you aren't adding a clear value add, it's very easy to build a vanity metric driven P&L business where you see explosive top line growth at wafer thin or negative gross margins, right? So you're effectively selling $1 of service for 99 cents. But I think Off Business is a great example for us, where we have a ROIC obsessed founder who is constantly thinking about how do I embed myself into my customers and my suppliers? How do I work with the incentives of all the people in the ecosystem without pissing all of them off at the same time? And how do I build a 20% plus ROIC business through the management of top line growth, margin drop down, and working capital? And I think if this founder team pulls it off, the runway to compound at 20% is truly limitless, right? They're number one in almost every space they touch. And yet in each of those spaces, they're sub 2% market share, right? So when you build a business that can compound at a 20% ROIC for 20 years, with clean corporate governance and all the other stuff, what is that business worth? 50 billion, 100 billion? So that's how we see it.
I'm going to interrupt for a second. I think 80% of the founders don't even know what ROIC is. And therefore, we should talk about it, because I think in the new world, people should understand that it's all about making money on the money that goes in.
There's no one better on this panel to explain the concept of ROIC to 200 Indian founders than Scott. So I'll defer to him.
Or Vishesh, but either one.
I know my founders are fed up of me hammering them on ROIC.
Revenue more than expenses, including non-cash expenses like stock comp. Just revenue more than expenses. It's just that's it. You put $1 in, and what can you pay out to shareholders over time? And of course, at least the vast majority of the companies we've ever invested in, vast, they have expenses higher than revenue for some number of years, but that structurally, from the first sales, they either mark up a product or they have a very credible path to mark it up over time. And yeah, like examples of where you're selling for less than your cost of production early, but it makes sense. Let me give you an example. In India, it would be a Flipkart, or in China, it would be a JD, where initially you're buying from tier 2 distributors. And so, yeah, your gross margins are terrible, but you know that if you can buy directly from the big brands, you can get the same product for 5 to 10% cheaper. And then you actually do it over the course of 3, 4, 5, 6 years. So all of a sudden your gross margins are going up, but it's just because you're buying direct. It's not because you're raising prices to customers. On fulfillment costs, of course, if you deliver, if you have to drive a truck to a neighborhood that is 20 miles away and with one package in a huge 18-wheeler, that's going to be very expensive per package. And if you can fill that same truck with 100 or 1,000, but it's about making very well articulated decisions about how you're going to make revenue bigger than expenses from the first day, not let's give it away and we'll figure it out when we.
Let me push you on that, Scott. But last 2-3 years, Matrix, Sequoia, Tiger, Falcon, Temasek, haven't we all been saying just grow? And what's changed now?
No, I've never said that. Just grow. I really haven't. I can't remember a single. Yeah, absolutely. There's calibrated aggression. There's a time to be aggressive, and that's maybe very, very early on when you're trying to figure out this matrix of Scott, where you need that scale, and whether you want to see whether you have that scale, whether your value proposition or your product market fit gives you that scale. But it's not. I actually think, if I look back on my mistakes over the last 10 years, there are 3 things that show up, or 2 things that really show up again and again and again, and shame on me. I'm now super sensitive to them. One is cheap and plentiful capital in the hands of young founders. And 2 is founders and or cap tables pursuing growth wantonly. And I don't mind, Peter Thiel always says that the genesis of most great businesses is you sell a narrow set of products and services to an easily identifiable group of people, and you become dominant in that space, and you build muscle memory, and then you take that left and right. And that's how Amazon started. That's how PayPal started, right? But what I find where we have gone wrong in the past, and where my founder set that has gone wrong have strayed, and I'm sure Scott and Vishesh may or may not have had the same experience, is when they've expanded left and right before building that muscle set, and the growth has been broad versus deep in the pursuit of a narrow vertical. And in a country like India, that's fatal, because you're growing your top line in places where you don't have the infrastructure, you don't have the people, you don't have the service levels, and all you're doing is exporting sort of capital burn from one location to the next. So those are my big lessons.
That's awesome. Thank you. Very well said. Scott and Vishesh, tips for entrepreneurs along the same lines?
I think it was very helpful that India internet went through a bubble in 2015. And we helped contribute to it at Tiger Global. So we're not casting stones. But if you look at, since the big internet bubble burst in 2000, I was still an analyst at Blackstone back then. So, was not involved in investing in private internet-enabled companies back then. But the closest thing that we've had to a proper bubble that burst was in India internet in 2015. And the reason I bring that up is that I think that was really helpful to, in today and in the last couple of years. And I think that while certainly the mandate has been growth in India, it was just fresher. It was fresher, and there had not been. I think many of us saw it. We saw companies that were doing pretty well, even in 2021, that were struggling to raise capital in India. clear unit economics, a solid team, a big market. And we were able to invest in some cases at where the comps would have suggested, if you looked at the blank of blank in another couple of big countries, we could have easily justified 3, 5, 10x the market cap, but there just wasn't capital available. And so, I certainly think we're never getting the dials perfect, but I'm at least I can just speak for a fact. In 2022, our portfolio of investments in India performed far closer to budget from the beginning of the year than our portfolio companies in any other geography.
Super. Vishesh, before I turn it over to you, I think this is a very important point for all of us to kind of process, which is there's going to be a lot of ups and downs, but India is net performing finally in the right direction. So hopefully all the founders on the chat can take inspiration from that.
Yeah. No, I think, look, I mean, the fundamentals of, what a good business looks like, never change. They're not subject to macro or market cycles or cost of capital, right? It's actually, not too difficult. It's, find a good product market fit, serve your customers well, do it in a manner that, that everyone in the ecosystem can be better off. You make some money, your customers are better off. And I think, you should not be in a hurry to do it. I think that's what, our learning has been, that everything in India takes slightly longer, is more difficult to do than in other parts of the world. So as investors, what we try to do is to underwrite to slightly less aggressive operating plans and operating cases. I think multiples wise, we often get asked, why should something trade at such high multiples in your exit assumptions? But I think, the combination of modest operating plan but punchy multiple has worked quite well for us in the past, right? So my advice to all founders listening to this is just build good businesses. Take your time to do it. If you do it well, if you focus on ROIC, the capital will be available, and the public markets will be very welcoming.
Super. We have hijacked Dada's Dada. I call Sudipto Dada. A lot of us do. We have hijacked his B2B agenda. So coming back, I think one or two of you alluded to corporate governance, and I don't want to go very deep into that topic because I think it is hygiene. But I want to get your view, Scott, Nav, and Vishesh. Are we out of line in corporate governance, or is it just regular part of growth? I mean, clearly we have screwed up and it should not happen. But is this normal, or are we in a different, are we an outlier in corporate governance in a negative way? Scott, you have seen a lot in China.
I would say, so when we first started, as you all know, founders weren't called founders 15 years ago in India. They were called promoters. And I think that is a difference. And there was something different about the promoter culture. Conveniently, it improved. And I don't hear the word promoter anymore. I almost never hear it in India. So we've certainly seen improvement, and as evidenced by recent corporate governance issues, and forget about publicly traded companies, even on the private side, including I think one of our portfolio companies. It was just in the last couple of weeks, it was reported that a bunch of the numbers that they reported to investors were likely fictitious. I wish I could say India was the only place that happens. It's not. And I think what's great is I like when the truth is always going to come out. My dad told me, and this is, please take this with you on your day or your evening. No one has a perfect memory. Anything you say, you will forget it. And so just tell the truth. Whatever you're doing, tell the truth, because you will forget your lies. You'll forget them and it'll all come back to you. And I'm glad that we see that happen in business too, whether it's your accounting, whatever you do. If your governance is not honest, it will come back to you and it will get you. So I think it behooves all of us to act ethically and with a high bar. And we've certainly seen lots of great behavior in India too.
Super. What a takeaway.
We are out of time. I think we are 7 minutes beyond time. So I know some of you might have a hard stop. So thank you so much. Maybe one last finishing thought from each one of you to the founders in India. It could be a suggestion, any area or space or trend line that you're seeing globally that you think makes sense for India, or anything else for the panel. Would be good to have a 1 minute sort of thought from each of the panelists, and then we'll wrap up. So maybe Vishesh, we can start with you.
Actually, I'll start while they think. So I want everybody to remember that in the next 6-7 years, India will add the same, and to Scott's larger point, please don't forget, we'll add the same amount in GDP, which is 3.5 trillion, that we have done in our first 75 years of independence. It's a big deal. It changes the game. And I don't think we understand how much it changes the game when the GDP per capita goes up the way it is going up. So super excited. You have like the best minds here. So super excited to partner with them also. But couldn't be more excited about right place, right time.
I echo that, 110%, if that's possible. I think Warren Buffett in some interview said that, if he had been born anywhere else in the world, other than America, then he wouldn't have been, the success that he's been, right? And I think that opportunity is, is literally at our doorstep. All we need to do is to keep doing the right thing, pick a real problem, solve it, with real focus, focus on profitability, build moats around your business. I mean, these are just, truisms that don't depend on, on which investor is on this panel, or, what the index level of the NASDAQ is, right? These will remain true 100 years from today, and just keep focusing on those.
First off, thanks everyone for participating, and yeah, we're going to continue to be data supported, but we based on what we're seeing, we would expect that the opportunity ahead of all of you is unique. India will gain more share than of GDP than any other country over the next 10 and 15 years. So let's all do our jobs, whatever that is, as a business owner or a startup founder or investor. And let's be disciplined and let it rip, and hopefully enjoy some huge prospective success.
Yeah, I think you guys have an enviable position. If I could be born again, it would be right now in this moment as a 20 to 35-year-old founder in India. You've got infrastructure that's been put into place. You've got capital. You've got a cohort and a generation of founders that have come and achieved success before you. You've got principles of corporate governance that are now well laid out for you. I think if you guys can find pain points, issues that consumers have, structure products around that from a first principles point of view, make sure you have product market fit. And as Scott simply said, build a business capable of generating revenues that more than offset all its costs. And that when whatever is left over is measured versus the capital you've used to build that business, that is a reasonably robust number. And I think there's no end to the market cap that you can create. We're open for business and really excited to help build the next set of great Indian businesses.
Great, fantastic. Thank you, Nav, Scott, Vishesh, Avi, for taking the time out. It's excellent to see the exuberance around India. And just one point for the founders, given this is DMI, if India's GDP has to become 2x and add 3.5 trillion, a lot of it will be on the back of agriculture, manufacturing, exports, real India propelling the GDP, which is why we are so bullish on B2B and agri-tech in India. Because if India has to succeed, some of these sectors also have to. So thank you everyone for taking the time out, and thanks all the attendees for spending time. So thank you so much.
Super guys, thank you.
Thank you.
Thank you.
Yes.
Thank you.